So I think it's time, since we have got only 45. Okay. So since it's time, we'll just quickly start. And since we know that we have only 45 minutes to get maximum knowledge that we can get today. So I welcome all of you to the second episode of Thursday Talks. And today we are going to talk about tax exemptions for startups and implications of raising overseas funds when it comes to startups or SMEs. I am Vaishali Jain and I'm Senior Manager with EBTC, that's European Business and Technology Center. And firstly, I would like to thank Magic and CII for collaborating for this and making this knowledge sharing series possible. So in today's session, it's a very crisp session and we are going to focus on three things. First is what are the tax related incentives that are coming from government for startups and SMEs. Second is how to pick the right type of legal entity structure when you engage into a business. And some more clarifications when it comes to angel tax, ESOPs, valuation of shares, etc. So Ashish, would you like to speak some few words for us?
Yes. Good afternoon, good evening. I welcome you all for this second session in the Thursday Talk series. This Thursday Talk series is specially arranged in collaboration with EBTC and CII. First, quickly, I will give you brief background about Magic. Magic is Marathwada Accelerator for Growth and Incubation Council, which is promoted by Chamber of Marathwada Industries and Agriculture CMI. It's a business incubator and SME accelerator, which is promoted by a regional industries association, and it's first of its kind in India. We are in operation since 2015, and we are supporting startups and helping SMEs to accelerate their growth. Magic has entered into a CSR partnership with Tata Technologies, and as part of this CSR partnership, we are hosting a virtual exhibition for startup ecosystem in collaboration with CII, wherein all the constituents of startup ecosystem have been given an opportunity to showcase their product or services, especially during this pandemic situation. And as part of this Tata Magic Innovation Hub at ICON, the virtual exhibition, we are supporting student-led startups, especially from Tier 2 and Tier 3 cities, so that they get exposure and opportunity to network with various players in startup ecosystem. And through such webinars, they also get a lot of knowledge connected with various aspects of startups. So I must thank EBTC and today's speakers for sparing time, and as they would be sharing very important information about tax exemptions and implications of raising overseas funds, which is very relevant and important in current context. So without taking much of time, I hand over this mic to Vaishali, and I also thank ICM Institute for partnering for today's session with us. And this session is being live streamed on YouTube as well as CI platform and Zoom also. So we have participants watching, attending this session on 3 platforms. Thank you.
Thank you. Thank you, sir. So without taking a lot of time, I'll quickly give you a very quick introduction of our experts here. So today we have with us Ms. Nidhi Maheshwari. Nidhi is chartered accountant with a diversified industry experience of over 20 years. And her specialization is in taxation, media, and financial service sector. She has extensively advised companies on corporate tax, entry and exit strategy, inbound and outbound investment structuring, and got a lot of experience in working with European clients, especially in Netherlands, France, and Belgium. Nidhi will also be moderating the session. So welcome to you, Nidhi. We have with us Rupal Kothari. Rupal is also a chartered accountant, and she has got over 11 years of experience in international tax and regulatory domain. She is a company secretary and has a wide experience of working in financial services, technology, and international markets. So just before we start, two quick house rules. Firstly, let's keep our videos and mics off when we are not speaking. And secondly, in case you have any specific question for our experts, please feel free to put it in chat box so that our experts can take the same at the end of the session. So without taking any more time, over to you, Didi.
Thank you so much, Vaishali. A very good evening to all, and good morning to some of the participants that I saw from joining us from Europe as well. It's a pleasure to be doing this session. So at the outset, thank you very much to EBTC and CII and the Magic team for giving us this opportunity. The topic on startups, can't get more interesting, and especially from a timing point of view, it's really a great time to be talking about it, right? India is in its 75th year of independence. It's time to really have a very strong buzz around the startup ecosystem, right? Just like any other country in the world, startups truly are, the pillars and the foundation for wealth creation, employment generation. So it's no surprise that, the Indian government also really is focusing on this agenda, and we have our own initiative in the form of a Startup India program itself. So, let's get into the specifics of it. And through the period of this next half an hour, 40 minutes, hopefully, Rupal and I will, walk you through some of the areas which will be very interesting, very peculiar and pertinent on the tax and regulation side on the startup space. So let me begin with my first question, Rupal. With so much buzz, on the tax benefits, and also some other non-tax, incentives which are given by the Indian government to startups, I think it will be very useful to first understand who is really eligible, how does one go about it, and who all within the startup space can look at, being qualified for this so-called, definition that we call as an eligible startup.
Sure, Nidhi. Good afternoon, everyone. Thank you, Nidhi. So, Nidhi, as you stated about the flagship program of the government, the Startup India, and if you look at that, the Startup India flagship program has provided the much-needed thrust to the budding entrepreneurs. The flagship program has already provided approvals to 62,000 and more startups and funded around 3,100 crores to such startups. If you look at to your question that whether all entrepreneurs are able to, get this recognition and tax benefits, the answer to that is that only the startups which are recognized by the Department for Promotion of Industry and Internal Trade, only those organizations are called as eligible startups for the purpose of tax and other benefits. Now, if we look at what are the conditions, the eligibility conditions for the startup recognition? The startup recognition is basically first and foremost condition is that the entity should be set up as a private limited company or a limited liability partnership or a registered partnership. The second condition to that is the turnover of that entity should be less than 100 CR for any of the previous financial years. So in case any of the financial year they cross the 100 CR limit, then they will not be eligible for the recognition. The third condition is that they should be in the first 10 years of their incorporation, and this is very important that only in the initial 10 years of incorporation they will be able to apply for this recognition. There are certain anti-abuse conditions also. That is, the startup should not have been set up by way of a splitting up or reconstruction. That should, in all, it should be a new entity by that manner. And the most important condition, Nidhi, is that they should be involved in innovation and improvement of an existing process or business. Their business should be scalable enough that they can create more employment, they can create more wealth. Then If all these conditions are met, they can make an application to the department, which is called as DPIIT. The department has set up a specific board, which is the Interministerial Board of Certification. This board looks into the conditions that whether the applicant meets all these conditions, whether their product is viable enough, is marketable enough, and whether there is actual an innovation. When all these things are met, they provide the approval. And once this approval is accorded, then that startup is called as eligible startup for tax benefits and incentives. So it's important that, whenever a startup is looking for getting these tax benefits, they look up these conditions and apply to DPIIT for the approval.
Right. Thanks, Rupal. So essentially what we are saying is that you need to be registered after, of course, meeting the eligibility criteria. Only once a startup is registered with the DPIIT would you then have an opportunity to avail of the benefits which the government provides, both on the tax side and non-tax side. And we will cover those specifics as well as we go along in this discussion. Right. So Rupal, I know you were assigned to the government, and you've worked in the DPIIT for about 6 months or so. So
voice, I'm not able to hear it.
Okay. Am I audible now?
Yes, you're audible. I think, Rupal, there's a disconnect on your network, I think. Is it better?
I think Rupal is having trouble with her audio. Yes. Rupal? Yeah. So Rupal, can you hear us now?
No, Nidhi, I think I'm not able to hear you.
Okay.
Probably, Nidhi, let's give a couple of minutes to Rupal to...
Sure.
Now.
Okay, perfect. Great. Okay. That happens with the technology. No worries. So hopefully all clear now, Rupal. So Rupal, I was basically just sharing that I know you were assigned to the government and you were in the DPIIT for about 6 months or so. It'll really be useful for the audience to also understand, some practical aspects around how long does it actually take to get such an approval, or any other practical insights that you want to share from your experience.
Sure, Nidhi. So, Nidhi, if you look at the DPIIT, which is set up in the Ministry of Commerce, so they, either meet fortnightly or at the end of the month to look up into these applications. The important criteria which is looked upon is that whether the startup or the applicant is actually involved in innovation. So, for example, it may be a new product, but there can be some competitors available in the market. So they look in that what is the innovation this new applicant is getting to the market. And in case it has an similar kind of product is already there in the market. So what is the edge of this applicant over the others? Is it cutting down the cost? Is it bringing some more technology to it? So typically they look into these criterias, and 1 to 2 months is looked into these factors, and then approval is provided. So more on to the focus is on the marketability, viability, what is the edge, these kind of conditions are looked by the DPIIT Interministerial Board.
Okay. Thank you. Then at least we are not talking of a very, very long timeline here, so long as all the other conditionalities, are available to the company.
Yes.
Great. So Rupal, at the beginning of this conversation, you mentioned about some of the prevalent legal structures of the companies, right? I mean, basically for any business to be set up in India, I think it will be good to also understand that for the startups, are there any specific nuances on the form of the legal entity structure that one should look at? Because there may be sometimes just a group of individuals coming together, or, there might be a proper corporate setup. So any guidance on that legal structure form?
Sure, Nidhi. So as you said that, there are various legal forms which are available for an entity to start up its operations. The predominantly the ones which are commonly used are the private limited company, the limited liability partnership, and the registered partnership. Of course, there are other models also like one-person company and sole proprietorship, wherein some of the individuals, as you spoke about, come together and then they start their operations. If you look at what are the key features of these legal entity structure, the first and foremost is, for example, let's take the private limited company. Private limited company is the most common form of startups, which we have seen practically also. And this is basically more governed. There is better corporate governance under this kind of structure. And it has limited liability, and the funds are infused by way of equity. If you look at the partnership firms, they only require 2 partners, minimum 2 partners requirement, less compliance. They are governed by the partnership deed, so to say, and the profits are distributed based on the capital contribution or the profit sharing ratio. If you look at what is limited liability partnership, it's a hybrid model of both, partnership firm and the company. So that means it has a limited liability and it's governed by the LLPD. On the compliance side, similar to companies, they are also governed by the Ministry of Corporate Affairs and has to do pretty kind of compliances for their regular operations. The another one is the one-person company. It's a very recent one, which has been provided by the government just to incentivize startups and innovators. So as you were mentioning that, individuals come together. So sole proprietorship is some of the startups. Initially, when they are budding, they come up, only the individual has the business idea. To bring those unorganized, businesses into the organized sector, this one-person company has been brought in as a new concept by the Ministry of Corporate Affairs. From the administrative and commercial standpoint, both LLP and company are the forms of structure which are very prevalent, and they are more or less on the same footing. But from the tax side, at some places, effective tax rate of LLPs can be lower as compared to companies. But the tax incentives which are available in the Act are mostly provided to the company structure, and the LLPs are not entitled to. And therefore, when we say that a particular person wants to, come up with a startup or set up its own startup, it's important to see that what legal structure they are coming up with. They undertake a cost-benefit analysis of both the structures, and looking at that analysis, they should finally conclude on what structure they should go ahead with.
Sure.
And as I've already highlighted, from the DPIT recognition point of view, any of these structures are like company or LLP or partnership would be good to go for the recognition of the startup.
Sure. Okay, perfect. That's good to know. And like you said, Rupal, I think even in practical experience, the way we see, I think the company form of a setup does come out as the most popular model. For the simple reason, I think with the amount of flexibility that it offers, and just the comfort that one has with that structure being the most old, right? So, but you're right. Everyone can evaluate the benefits, especially with the likes of LLPs, etc. If there are any pertinent situations which warrant such a different structure. Great. So now that we know about the DPIT approval registration process and how to go about it, etc., I think let's dive into the most important topic of this thing as to what does it really mean, Rupal. So once one gets a registration or once one is an eligible startup, let's start with understanding what are the tax benefits that one actually enjoys if they are indeed registered with DPIT.
Sure, Nidhi. So as I highlighted that the tax incentive go back to 2016 when the government started with this flagship program of Startup India. Since then, government is thinking on the lines of bringing more and more tax incentives and benefits for the startups. And these startups are the ones which are recognized by DPIT. If you look at, there are most 5 to 6 kind of tax benefits which are available to startups and their investors. And the first and foremost one is the 100% tax holiday. This 100% tax holiday is in a way exemption from tax for 3 consecutive years out of 10 years of incorporation. So the eligible startup can choose any of the 3 consecutive years out of its 10 years of incorporation and can take this benefit. For this benefit and to ensure that this benefit is not taken as a tax planning tool, there are certain anti-abuse conditions which are attached with this exemption. First condition is similar to what was there in the DPIIT. That means they should be a new entity not set up by splitting up or reconstruction of an existing entity. And the second condition is on the plant and machinery side, that they should not, old machinery should not be transferred to this entity. Obviously, a 20% kind of benefit or a leeway relaxation is given, wherein up to 25% the old plant and machinery can be transferred to the startup entity. So this is one of the most important benefit. Coming to the other benefits, which are other tax benefits which are available, are the, for example, the deferral of ESOP taxation. We have seen that startup uses this ESOP tool as one of the effective tool for retaining its talent. Now, the question was that, once these ESOPs are allotted, there is a lot of hue and cry that, at the time of exercise, this was being taxed. So government came up with a solution by deferring the ESOP tax up to 4 years from the date of exercise, or 14 days from the date of sale or cessation of employment. The the sore point here I would like to highlight is that, for example, an employee changes its job, then either it has an option to lapse that option which has been given by the company, or it has to pay tax at that point of time. So, that kind of evaluation one has to do, and then pay tax on the ESOP which has been granted. The third kind of benefit is the patent box regime, which is called, and this is basically intended to promote the indigenous development and registration of patents in India. In this, 10% gross rate is applicable on the royalty income from such patents. So the idea is the startups which are deriving their maximum value from the intellectual property, they come and register in India their patents and get a benefit of 10% flat rate on their royalty income. The fourth benefit is the benefit for the capital gain exemption, which is available when a particular investor sells a residential property and earns long-term capital gains. They bring that consideration, invest into the eligible startup, with the condition that eligible startup needs to invest into plant and machinery within a period of 1 year. Once that is done, the capital gain exemption is provided to the investor. So this is to bring in more and more investment into startup and promote the mindset of investing in startups. The another benefit which is provided, Nidhi, is on the set off and carry forward of losses. Now, we all know that startups, initially when they come up, they only have few promoters, the ones who had the budding idea of the new business or the innovation. But as they grow in their journey, there are new investors, PE funds, venture capital funds, which comes and funds these startups. So it's very difficult to maintain a shareholding of 51%. And which is one of the criteria for carry forward and set off of losses by a private limited company. So with this, condition, government came up with a relaxation specifically for startups. They said that, okay, if your shareholding goes even beyond 51%, so far as your all shareholders, that means mostly the initial ones, the promoters, they are continuing with the company, and they are continuing with the company, then the company will be eligible to carry forward and set off the losses. So basically, if the promoters who initially started with the idea are still in the game, they have their skin in the game, then the carry forward and set off of losses would be available. So these are the typical kind of tax benefits which are provided to the startups and the investor in the Income Tax Act.
Right. So that does sound like a handful of incentives, essentially considering the tax holiday itself. But yes, the conditions do sound somewhat maybe not so easy for everyone to satisfy. But all in all, I think from a government intent standpoint, yes, considering some of these carry forward of business loss related aspects, it's a good thing that they have considered some of these, because I know this used to be really an ask from the startup community ever since this benefit was announced by the government, for the simple reason that, yes, it does take a fair bit of time to turn it around and turn profitable on the startup side. So thanks for that, Rupal. Now, so having understood a little bit about the benefits, let's shift the gears and talk about the challenges. And I think when it comes to challenges on the tax side, one of the most talked about term is really this angel tax issue, and could you just make it very simple and easy for this audience to understand what is this issue about, what are the technical provisions which is triggering this problem, and especially since you mentioned so rightly that after a startup proceeds in its journey further, there is definitely a huge amount of funding that is required. So definitely they will be inviting more and more investors to invest into the company. So what are the tax issues and what should one be prepared for to avoid any sort of issues in the tax, on the income tax side?
Sure, Nidhi. So, Nidhi, as it's commonly called as angel tax issue, and this angel tax issue dates back past 2 to 3 years. This was a significant concern for the startup community, and they were haunted by. And this all controversy actually started by tax authorities started issuing notices to these startups and questioning the amount of premium they had received at the time of funding. And this is basically, the notices are under a specific section, and technically if we say that section is 5627B. And what actually that section talks about is that in case a investment is received from a resident of India, then the premium which is received in excess of the fair market value, and there is a prescribed method how to compute this fair market value. So typically whenever a premium is received from a resident, then this excess premium which is received, that is taxed as other income in the hands of startup. And because of which there was so much of questioning by the tax authorities, and finally the Central Board of Direct Taxes as well as DPIT came up together. They brought in relaxation, and they said that startups would not be subject to tax for receiving any excess premium beyond fair market value in case they are notified for such exemption by DPIT. So similarly to the startup recognition criteria, there is an exemption notification which has been brought in, because of which startup now needs to apply to avail this benefit or exemption. So they need to get their name notified by DPIT to get this exemption. The conditions, but interesting part is the conditions which DPIT has put up, with this recognition. The first condition is that the total paid up capital of the startups should not exceed 25 crores. Now, if we look at that, if a startup is growing, 25 crores looks like to be a small amount. The second condition attached to it is startups should not invest in assets like land, buildings, share capital, or luxury items, motor vehicles. So if you look at, the framework or the startup ecosystem, these conditions are very difficult to manage. So in a way, angel tax issue has been to some extent put an end by bringing up this notification relaxation. But at the same time, there is still, this issue persists because of the stringent conditions attached to it.
Right.
Yeah. And also, in our practical experience, Nidhi, though this section is only applicable to the resident investors, but questioning from the tax authorities happen on the non-resident investors as well. On the technical side, one can obviously answer that this provision is not applicable to the non-resident investors, and in case further questioning happens from the tax authority sides, entire trail of documentation, that who is the non-resident investor, genuineness, source from which this investor is funding, can be provided. But still, this questioning happens, and practically this is a most important question which is being asked to the startups these days.
Right. But so on a lighter note, if I was to summarize, one can say that if the startups are going to the Indian Shark Tank to raise funds, then this angel tax issues can come up. But if you go overseas, then strictly speaking, the provision itself on the angel tax issue that we call doesn't trigger. But you're right. On the field, there is still a lot of questions. So just on an overall basis, very important to understand when you're raising funds, the related tax aspects and the incidental valuation aspects that one does need to consider. Right. And I think to your point, Rupal, yes, the conditions do sound stringent. A little bit more leeway would have been appreciated. And with the budget round the corner, one just hopes that there is some relaxation made on this front, on the condition side, as well as, you know, this whole difference in the tax rates itself, right? For a listed company, you get a 10% tax on the capital gains, whereas for the shares in an unlisted, of course, from the startup side, the rate of capital gains tax going to 20%. So, you know, one does hope that our finance minister plugs this gap. And, you know, now the budget is just around the corner. It's on the 1st of Feb. So let's see if some of these aspects are duly addressed in the budget 2022.
Yeah.
Right. Excellent. So now moving to the other point, Rupal, we've discussed the tax incentives, and you spoke about all of the several tax incentives available on a DPIT registration to an eligible startup. Can we now discuss some other incentives beyond tax? On the non-tax side, what kind of benefits can one expect with such an approval?
Sure, Nidhi. So Nidhi, the Startup India flagship program, it's not only, you know, extend benefits from the tax side. There are other benefits also, other ministries also who have come together, other state governments also who have come together to promote the idea of startups in India. And if you look at, you know, from the RBI side also, the relaxation is provided in the external commercial borrowings. For example, the overseas loans which these startups can take, there is a host of conditions otherwise which was applicable. For the startups, they have been further liberalized. For example, the debt equity ratio which needs to be maintained of 7:1 in case of any other company, they are not applicable to the startups. And similar, you know, there are other conditions so that, you know, startups can access the overseas loan market and get funds at a lower interest rate. In addition, this is from the loan side. If you look at from the equity side, obviously foreign investment is permissible under 100% automatic route. If these startups are engaged into sector which are permissible, so to say, like they are not governed or under the approval route, like for example, real estate, defense, etc. To further, you know, bring in more funds or attract investment from the overseas, especially from the foreign venture capital funds and units, these startups issue convertible notes. And this foreign venture capital can freely, you know, invest into the convertible notes issued by startups. So this is one of the very important relaxation or kind of incentive which is provided to the startups from the, you know, investment point of view. Now to talk about what are the other, you know, relaxations in the, like not on the tax front and not on the investment side. So for example, when they go for a filing for patent, 80% rebate is provided to the startups on the filing fees. If you look at the public procurement tenders, so they are provided more of benefit without, so the conditions like prior experience, prior turnover, registration on the GEMS portal, public procurement portal. So all this kind of conditions are relaxed for startups so that they are at equal footing as compared to other companies as well. Then there are relaxation in a way to ease the burden of compliances. So they can do a self-certification for labor laws and environmental laws. And when we say labor laws, around 6 to 7 labor laws and 3 environmental laws, they can definitely go and do self-certification. And no audit will happen for 3 to 5 years. So, you know, they are pretty much, you know, free from the burden of compliances on the labor and environmental side. So this is one of the additional benefit which is provided to the startups. And in addition to that, obviously from the GST side to the MSME who does not have turnover of more than 5 CR, there is a ease of GST compliances. So in a sense that they can file quarterly returns instead of monthly returns. So this is also reducing the compliance burden. And when we talk about the incentives, state governments, different states come up with different incentives for different kind of industry. So every state has kind of incentive plans. If you invest in a particular state in a manufacturing or ITs, they provide benefits on the amount of capital invested in their state. So these are, you know, few of the benefits which are provided other than tax to the startups, so that more and more people come and invest in India, and the startups flagship program is successful.
Right, right. Sure, Rupal. Specifically, Rupal, on the GST side, the turnover threshold that you mentioned, I think if you could just repeat that for clarity's sake. I think there are two questions in the chat box, which I think will get addressed with that exemption of condition.
Sure. When I say GST ease of compliances, so if the turnover is less than 5 crores, then they can go for a month, instead of a monthly return, they can go for a quarterly return. This is to provide that there is certain relaxation on the compliance side.
Sure. Right. I do hope that addresses the specific question that was raised there. And you're absolutely right, Rupal, when you talk about the state government's benefits that you're talking about for the startups. These days we are actually seeing a lot of interest, especially it's almost like a very competitive environment, so to say, also within India, right, as to which state do you set up your base in. So it would be also very useful for all the startup community to also know of such benefits that a particular state can indeed provide. And all of these other non-tax benefits also that you mentioned are indeed quite attractive. So one does hope that the most of it is being actually made of by the relevant players in the startup side. So I think this has been a very at least useful information, Rupal, and thank you for sharing so many tax and non-tax incentives which are available. The whole process of going in for a DPIT registration, what does it take for someone to be eligible, and I think, well, one just hopes that with all of this importance to startups, with the importance and the thrust that one wants, one just also hopes that the tax and regulatory regime also easen out a little more to be able to give this the much needed thrust and boost. But at least the good news is that the government has been constantly doing things every now and then, and this just shows their commitment to make the startup initiative indeed work. And this can be really seen from the startups which are actually going in for registrations. The amounts that you mentioned, of course, it doesn't seem like a very big number still. And with the kind of ecosystem that a large country like India, and we are, I understand now we are in the third largest in the world, one can definitely do with a lot more push to these to get the so-called eligible startup benefits. But at least we are moving in the right direction. And with this budget, we can only expect a little bit more, clarity or exemptions, especially at least on the capital gains taxation side, between the anomaly between the listed and the unlisted one. So with that, we are doing well in time. Vaishali, we have stuck to the ask that you had. So we do have 5 minutes and a little over 5 minutes for the Q&A as well. But before we get into that, maybe we'll just pause for a moment, Vaishali, if you want to come in at this stage.
I think we are good. So I think we can also skip immediately to the question. So in case anybody has any questions, probably you can raise your hands and then we can get to it.
Right. So would be good to also get any question on the audio, and we do have a raised hand from Harsh.
Yeah, so I just wanted to ask, like, whether NRIs can have shareholding and a directorship in the company. Is there any regulation prohibiting or barring them? By, like, in case of regular companies, you have to have a resident director to sign all the documents and returns. What about NRIs if they want to have a startup in India?
So,
right. Go ahead.
Yeah. So Harsh, like if they want to have a startup in India, the condition of resident director still, exists. That's not gone away for the NRI investment, but their investment can be done provided they meet all the conditions. They are into the sector which I highlighted, are under the automatic route. They can very much bring in funds in India and they will be treated like a normal resident Indian. So NRI and the persons who have the overseas citizen of India, both of them are treated like resident Indian from the investment point of view, if you look at the FEMA regulations.
I hope that answers your question, Harsh. Okay, maybe we can move to the next one then, to Prashant.
Well, thank you. Simple question. I have GST registration, and my business is not getting revenue of even 40 lakh this year. Next year, I'm also seeing that I will not be crossing 50 lakh. So is it possible that if I don't charge GST to my customers and allow them to debit TDS at the rate of 10% or whatever it is, and then claim it from ITR by filing ITR?
So, Prashant, if you look at from the GST side, obviously we are the direct tax experts, but still, in our experience, what we have seen is even if you don't cross the threshold, it needs to be seen that you get the exemption and from GST side. And from the return filing, that even if you don't have a revenue of single rupee, then also GST returns needs to be filed. So it's not that, if you are not having revenue of, you have revenue of only 40 lakhs, then no compliances are required from the GST side. And regarding, GST being replaced by TDS, it needs to be, done only when you have an exemption from GST. Otherwise, it would, may result into, GST non-compliance. So
my question is, I have a registration of GST, but am I allowed not to charge GST from my customers?
No, so that's what I'm saying, Prashant. This kind of option is not available in the sense that you replace GST and not this kind of voluntary not leaving GST on the invoice is somewhere not available in the GST laws as well. Until unless you have an entire exemption, your product falls into the exemption criteria, then GST is not applicable on that.
Got it. And can I do it after getting deregistered from GST?
So, deregister from GST, just to tell you that once you deregister from GST, then you come out of the entire net of some of the vendors would not be interested in dealing with you because you're not registered under the GST. So, so this is a, one has to have a well thought discussion before taking this step, because once you, for example, once you deregister from GST, then going back and taking registration at a later point of time can also be questioned by the GST authorities.
Got it. Thank you.
Sure.
Thanks. We can move to Sharvi.
Hello. Hello.
Yes, please. We can hear you.
Yes. Yeah, ma'am. This is NK Bhatt. I have a question that I am running a startup, right? And since a startup is not moving the way it's supposed to, so I am doing other jobs also using same company. Means there the GST is going up to 18%. And in my food business, where my startup is, it is in 5% GST. So what I want to know, will it be impacting me anywhere?
Sir, if you can, I understand your question that, under their same startup, you're doing a food business as well as some other jobs.
Yes,
so
same,
as to
yeah.
Continue. So what's the question here, sir, exactly?
My company, see, it's a startup company, right? And we are doing cold pressed wheat flour. So it attracts 5% GST only, right? But since this business is not that much higher wavelength so far, that so I am continuing some other businesses like construction related, where I am doing business with 18% GST. So what I want to know, see, in future or maybe in coming years, when this business will be flourish in a right way, will it be impacting me when that other business is going with 18% and this one is going in, or I should separate both of them in different companies?
So, Nidhi, should I go ahead?
Yeah, sure.
So, sir, I mean, there is no such kind of restriction that you can't have two set of business operations under the same company. But as you said that in case in future it flourishes further, your main business, which is like 5%, which is attracting 5% GST, then at that point of time you can see that, because from the administrative point of view also, if you and from the tax point of view, it's better if you kind of bifurcate these two business operations into two different entities. You can, at that point of time, you need to see that what are the tax ecosystem prevailing at that point of time. At present, so far, because these two businesses are running parallel, that's fine. But in future, this needs to be seen that how if it's continued in the same business company, then is it impacting your overall administrative and tax quantum, effective tax rate quantum?
Okay.
And
my another question is, I have some friends in other countries, right? So if they want to invest with me, how I can introduce them in my company? Is there any way that I can offer them directorship or something else? Or what is the easiest way? Actually, I don't know.
So I think Rupal mentioned this in the earlier part of the question as well. So far as the foreign investors are concerned, there is no problem for them to invest into the startups. So to your point, your specific question, if you have friends overseas who would like to be a part of your startup, it's totally, driven by your business needs as to would you like them to participate as a director or as an investor, as a shareholder. You want them to come as an advisor. You want to have a technical services arrangement with them. There are various options depending on their qualifications and your business commercial arrangement that you would like. But otherwise, just because they are overseas, there is no prohibition for them to participate in your business as such.
Okay.
Right.
Right. Thank you.
Right. And I also wanted to just add to the specific point that, if you have different businesses housed in the same entity, and at some point you want to take this eligible startup related registration, I think to that point also, Rupal, I think there would be a need to then have a segregated business in a separate entity, which goes in for that, approval and the process of DPIT, so that, your benefits, etc., will only apply to that company. So that's also another.
Yeah, it is actually my worry.
Yeah.
Thank you.
So sure, no, you should consider that appropriately.
Yeah.
Welcome. And one more question on the chat box is also on NRI having similar problems with Indian investors or the foreign investors. So Rupal, feel free to add, but the short point is that so far as the tax is concerned, the non-resident, even though it's a non-resident Indian, but so far as they are non-Indian tax resident, which basically means they are an overseas investor, then they will be treated as foreign investors. So for tax, for tax purposes, it'll be the same. So unless you want to add anything else on this, Rupal.
Yeah, so maybe for the tax purposes, as you rightly pointed out, they'll be treated like non-resident. But from the foreign exchange regulation point of view, they will be treated like a resident investment, so that their capping limit, the sectoral capping limit, if it's 100% automatic or in case it's regulated, would be determined accordingly, and they'll be treated like a resident investors.
Sure. I think, Vaishali, would you like us to continue with a couple of more questions? Or
I think we can take one last question, because this one seems to be interesting, because I personally feel that this is kind of happens with a lot of places, that will there be any tax liabilities if funds are raised through a seed fund or a grant from an incubator?
Sure. So Rupal, feel free to add, but I think, the whole funding aspect, seed fund, incubators, and all of these, there are a lot of structural aspects that one needs to consider. It's actually beyond just, there is no tax liability as such directly on investment itself, but how you're mapping that whole structure, how will the payments, how will you repatriate your funds? And are you raising this from India, overseas? What's your, is it a venture capital fund which is registered in India, overseas? A lot of these aspects is what one needs to consider. So unfortunately, I don't see any easy way to answer that specific question without having a more follow-up questions on that. But I'll also have Rupal add anything as relevant.
Yeah, Nidhi. So you've rightly pointed out there are specifics attached to it at the time of investment. Obviously, until unless they are the resident investor, which we spoke about the angel tax issue and the other issue. Until unless that is the case, then the tax implication needs to be seen. But otherwise, at the time of investment, more or so there are no. I mean, there would be no tax liability as such.
Right. And I think one question was there on Rupal's sole proprietorship structure being eligible for a startup or not. I think you did clarify that at the beginning, but you may just want to mention it again.
So, as we spoke that the eligibility criteria for startup recognition, the first condition is that entity should be a private limited company or a limited liability partnership, or it should be a registered partnership. Now, when we say sole proprietorship, it does not fall in any of these criteria, and therefore it would not be eligible for the tax benefits or recognition with DPIT.
Right. And would that be the same, Rupal, for the one-person company?
Yeah, Nidhi, because one-person company is not a private limited company, and therefore it would not be eligible for for applying for the recognition.
Right. All right. So Vaishali, we've tried to address most of the questions, I think all, and at least on the structure bit, on the seed fund one, we are happy to take those questions later as needed. And I think someone had raised a question on sharing our coordinates, and I think Vaishali, you may mention that they can feel free to reach out to you, and you can loop us in as needed.
Okay, I'll just key in my email address. So in case you have any further questions, you can just write to us here. And also a very big thanks to Nidhi, you and Rupal, you for taking so many questions and giving us so many great insights. Like those were technical enough and those were simplified in a way that everybody could understand it. And I think that's what makes knowledge more useful when you're able to understand it. So just like me, I hope there'll be so many people who will be coming out wiser from this session. So thank you. Thank you, Nidhi. Thank you, Rupal. Thank you, CII and Magic again for coordinating this session. Thanks all. You may have a great evening today. Thanks.
Thank you all. Yeah.
Thank you.
Thank you, and wishing everyone the very best in their startup ventures.
Thank you.